Tell us about the different loan options, right? There's a bunch of programs out there for, I would say, depending on sometimes people's career, right? A doctor or an attorney, I think, or, being a teacher or whatever they're, I mean, can you elaborate on some of the popular loan programs or what people can expect?
Yeah, popular loan programs, you're looking at conventional loans, FHA loans, VA loans. Within conventional world, you have jumbo versus non-jumbo. A conventional loan is your most common loan program that there is out there. It normally just requires 5% down. A credit score minimum that meets the lender's minimum, usually around 600 to 620 or so, and specific debt to income ratio that you can't go over, that Fannie Mae and Freddie Mac kind of assigned for us. That one is pretty straightforward. With that one, if you put less, I want to talk about the details a little bit. If you put less than 20% down on this type of program, you have to also pay private mortgage insurance, which is also known as PMI. PMI does nothing for you as a borrower of the loan. It protects the lender in the event you were to foreclose on the home in the future. It's an insurance that the lender has, but you're paying for it on a monthly basis as a buyer. And so with a conventional loan, again, minimum 5% down, that cost for PMI gets cheaper and cheaper for every 5% you put down. So from 5% to 10, 15, and eventually 20, it goes away. Also with conventional loan, if you're a first-time homebuyer with a credit score over 680, you can do 3% down. The perk of all of this is it makes it easier for you to get your foot in the door for a home, right? That you have less down payment in order to get in. And then, over time, as you pay off the loan and you get to that 20% equity mark, that private mortgage insurance goes away, and then you don't have to worry about that. There's different guidelines on how to get it removed. Usually, sometimes there's a 2-year waiting period from the time that you close. Sometimes if you get an appraisal done under less than 2 years, but maybe you've gotten down to 75% loan to value, or which means 25% equity, and even that changes sometimes. So it just depends. That's going to be a question you'll have for your loan officer. But that would be conventional. Next, you have an FHA loan, which is a government type loan. Most people think that's a first-time homebuyer program, but it's not. Anyone can take it out as long as this will be your only government-issued loan or government-backed loan. Correct. Only one FHA loan at a time. FHA's awesome because it allows you to have lower credit score requirements. I've seen as low as 560 in some places. It is a 3.5% down payment program. So again, on the lower spectrum in terms of down payment. The benefit of the program is, again, it gets your foot in the door a lot easier because it's less out of pocket. The downside with FHA is that private mortgage insurance that we talked about is on the loan for the life of the loan. It never goes away. So the only way you can get rid of it is if you refinance out of the program or you pay the loan off. Also, FHA requires an upfront fee for private mortgage insurance. It's usually 1.75% of whatever the loan amount is. So that gets added on day one on your loan. So you start to pay interest on that. So easy numbers, if you had a $100,000 loan, you'd automatically on day one start your loan balance, not with $100,000, but it'd be $101,750. So you're gonna pay interest on that over time. Again, great program to get started with, but long-term it cannot be as great of a program. The third most common one would be your VA loan. That's going to be designed for veterans, active and non-active veterans. That's another type of program where normally you can only have one at a time. The great program for that, or the great benefits of a VA loan, is the fact that there's no PMI and you do 0% down. So that really saves you money. And so that program will save you short-term and long-term. The VA does have what's called a VA funding fee. So they do have a fee similar to that upfront insurance for FHA. This is separate. This is just to help continue to fund the program. They do have a VA funding fee, and the cost of that varies whether it's your first time or your second time, or maybe you're a disabled veteran, you're a Purple Heart recipient. There's a lot of different variables, but having that conversation with us, we can explain that all to you, based off of your situation. But that program is amazing. If you can qualify for VA, that's going to be very helpful. The reason why I wouldn't go VA is maybe you're a buyer that can do 20% down, and you want to do that because maybe you want to keep your payment low. If that's a situation, you're already avoiding PMI, so it doesn't really make sense to make use of your VA benefits. Let's save those for another purchase down the road. Next, you'll have, I talked a little bit about a jumbo loan. A jumbo loan is essentially a conventional loan, only The jumbo loan is for higher loan balances. So this jumbo loan limit changes pretty much every year. It's changed. It doesn't always change every year, but it's changed every year for, I want to say, since 2016. So as of 2023, the loan limit is $726,200. Very random numbers.
That's the minimum?
That's the minimum to be a jumbo loan.
Of the loan balance, not your purchase price.
Of your loan balance, correct. And the purchase price is usually higher than that. So like if you had a purchase price of $730, more than likely your resulting loan would be below that limit, so it wouldn't be a jumbo. The thing about jumbo is, normally you want to see a higher credit score, right? Because in the lending world, everything is risk-based. So if we have a higher amount of debt that we're releasing to you, we want to see that you're a highly qualified buyer. So normally you'll see, credit score requirements 700 or above. Sometimes you want to see, more than 5% down, 10, 15, 20%. And we do have ways of doing 5% still, but it is scrutinized a little bit more. But if you can qualify for it, the rates are usually pretty competitive. You can start getting into flexible options like adjustable rate mortgages and interest only type loans. And so those programs are designed more for somebody, obviously, who's going to be at a higher price point. Beyond that, I would say, those are the most common ones I run into. There's other types of programs. There's other type of fee structures. If we want to continue down, and I could talk about this all day, a lot of times people ask, well, what about points and fees? What does that mean in terms of your loan program? And basically, that a point is just a fee that you pay in order to decrease your interest rate. And you can do that on any of these loan programs. You can elect to pay more in order to have a lower interest rate. It's my job to explain to you when we're going through this process of what is the benefit or the break-even point for you to do that. Meaning, if you were to pay an extra $5,000 today, at what point over time do you recoup that in terms of savings and interest, right? Is it 3 to 5 years? And if so, do you anticipate keeping this home for that amount of time and more? And if so, then yeah, let's go ahead and do that. If not, save your money today. And if your plan is, I'm going to sell this home eventually because over time we're going to grow a family or we're going to move out of state, then don't do those kind of things.